guys, and good morning. This is the month of September almost coming to an end, but you still have October, November, and December, three good months to prepare. And while you're preparing for the tax, specifically direct tax, and if you feel what are the amendments applicable to Jan 2026 exams, this video covers it all. Watch it. My name is CA Sourabh Mutha. I am a DT and GST faculty, and here to give you all the amendments applicable for Jan 2026 exams. I'm going to discuss them chapter wise, so you have no problem at all. And once you finish the portion, ideally, is when you should top up these amendments. So that will really, really help you. Let's see कौन से amendments आए हैं. What are the amendments applicable to Jan 26 exams? Here we go. This is a chapter-wise link, and I will attach the chapter-wise link in the video. I'll also update some other links so that you can access a lot of documents from my side. All right, let's talk about the DT amendments. This is specifically for DT. I'm speaking about Jan 2026 exams. Let's talk about the first chapter, that is salaries. As you know, guys, in salaries, you're working for someone and you get salaries, you get allowances, you get perquisites. All three are taxable. Then you have three deductions. One of them is standard deduction, 50,000 in the old scheme, 75,000 in the new scheme. This is something that you know. Now I'm talking about a very important perquisite called accommodation. You're working with some company and the company says, listen, we like you so much, we'll give you a house to stay. They own the house, you don't own the house. It's in the name of the company, but you get to use it for a particular number of months. That is called accommodation. Is that a perquisite? Yes, because it is owned by the master or the employer and enjoyed by the slave, that is employee. I call them master and slave in my lectures. And in that way, you have to understand this perquisite. Now, a small change applies to this perquisite. Earlier, the perquisite valuation was different. It was 10%, 15%, 12.5%, depending on the population. But now for Jan 2026 exams, this has been changed. So here it is basically very simple. It is 10% if it's a big city like Mumbai, metro cities, etc. 7.5% if it's smaller cities, and 5% if it's the smaller cities. Now, this is based on population. I'll tell you the number, but don't worry about the population. Bigger cities like Mumbai, etc., if they give you the exam, 10%. If the population is more than 40 lakh. 7.5% is between 50 lakh, 15 lakh to 40 lakh, and 5% is if population is up to 15 lakh only. So these are the rates for accommodation. Definition of salary is different here. Please make sure you know them. Before we move ahead, I would like to talk about the Jan 26 exam. For your exam, guys, the Finance Act that is applicable is still 2024. Yes, that's right. And the previous year in your exam is 24-25. What do I mean? The exam questions will be always on 24-25, which is assessment year 25-26. Keep this in mind for your exam. All right, I'll just give you a small pro tip. If your exam in the month of January 2026, then 6 months before any notification, they will not consider. Only 6 months earlier, they will consider. So don't worry, I've covered them all here in this. And this is the basis is ICA material. Next. If let's say the accommodation perquisite, you get a house or you get an accommodation and the perquisite is let's say valued at 2 lakh rupees. Now what they will do is they bring in a new amendment so that this is not unnecessarily high. The government has said that listen, we will compare. If this house has been given to you for at least 1 year, that means in the last 1 year, the house has been occupied by you, then in this only in that case, this new amendment applies. They will say we'll take the perquisite value given last year. If the perquisite value given last year was let's say 1,60,000, then they will divide it by the CII of last year. CII means the cost inflation index, and they will multiply by the CII of the next year. CII was a concept in capital gains. They are now brought it in a very small manner to salaries as well. So let's take an example. If it was 1,60,000 and the CII of last year let's say 300, and the CII of this year is let's say 400. I'm just keeping random examples. So 1,60,000 divided by 300 into 400 will give you 2,13,333. Now the government says 2,13,333. Your value is 2 lakhs, so 2 lakh is okay. But if the accommodation value that you calculate goes more than CII, this calculation, example, if the number was not 2 lakh, but it was 2,30,000, then we would consider it only at 2,13,333. I don't think this is important in the exam. I'll just summarize this. So if the accommodation has been given to you for at least 1 year, then the CII number is the maximum amount of perquisite for accommodation. All right, let's move to the next chapter, house property. You have a house, given it on rent, LOP. You have a house, you stay in it, SOP. You have more than two SOPs, it will be considered as DLOP, and so on and so forth. This chapter, very small amendment in this chapter, guys. They say that if you're renting residential house property, you know, guys, not an office, not a shop, a residential house property, then it will always be taxed under IFHB, even if it's done as a business. Sir, what does this mean? I'll tell you. If I have one shop given on rent, I will tax it under IFHB. But if I have 10, 15 shops given on rent and that becomes my business, that will be taxed under PGBP. But that cannot happen if it's a residential house property. That's one important amendment. In the exam, if they say Mr. A is a businessman, he gives residential houses on rent as a business, even then it will be taxed under IFHP. All right. We go to the next chapter. I'll straight away jump to the last chapter or to the chapter that is rates of tax. For Jan 2026 exams, again, the Finance Act is 2024. The previous year and assessment year are these. Now, if in the exam they say that the person has opted for the default tax regime, default basically means the new tax regime, or they will say that the has person has opted for the out of the old default tax regime. That means he's opted for the old tax regime. See the words very carefully. So, what if there is no word given in the exam? Then in that case, you will use the default tax regime automatically because the word only says default. Here, guys, the slabs have changed a little up to 3 lakh, 3 lakh to 7 lakh, 7 lakh to 10 lakh, 10 lakh to 12 lakh, 12 lakh to 50, and more than 15 lakh. How do you remember them? Up to 3 is okay. 3 to 7, 3 plus 7 is 10. So 7 by 10. Then 10 to 12, 12 to 15, and more than 15. And the government doesn't like 25 number. And Nirmala Sitharaman doesn't like that number. So 25 is not there. 0, 5, 10, 15. It increases by 5% up to 30. This is applicable for Jan 26 exams. Don't fall for any other slab rates. These are the only default tax regime slab rates that are applicable for your exam. Next, let's go to a nice chapter called income from other sources. If there is an income which is not taxable under any other heads of income, you will put it under IFOS that you already know. Now in IFOS, there's a new concept called deemed dividend. Let me explain what. With an example, we'll explain there is a company called Infosys. Right now, this is a live example. Infosys has said that I will buy back my share. Let's say right now the Infosys share price is 3,000 rupees and you're a shareholder who's bought the share for 3,000 rupees. Infosys says that I will buy it for 4,000 rupees and will pay you 4,000 rupees. This is called buyback. Now earlier guys, up to 1st October 2024. Before that day, before this time, if there is a buyback, then that tax would be paid by the company and you don't have to pay any tax. Life was good. This amount, entire 4,000 was exempt under a section called 1034A. But after 1st October 2024, or after, this section has now been removed. Now the government says, listen, if you are making money, you pay tax. So what is the thing before? So if it comes before 1st October, then it is exempt, don't worry. But if it's after 1st October 2024, then this is the case. It's very simple. There are two implications. First, whatever 4,000 rupees you got from Infosys will be taxed under IFOS. The entire amount, yes, the entire amount, no reductions, not at all. This is deemed dividend under section 222F. That is the first case. And the second, sir, what about the cost of shares that I bought for 3,000? That will go under capital loss. It is a capital loss. So 3,000 you can minus under capital gains as a loss. So these are two implications for buyback. Very, very important. The section is important. The two implications are important. And the date of 1st October is very, very important. Keep this in mind. This is basically deemed dividend under section 222F. Let's move ahead to something very different and interesting which is happening, which is called life insurance policies. Let's first talk about life insurance policy. You take a life insurance policy, you go to an agent, you pay a premium every year, you pay a premium for a few years, and your life is insured. If something happens to you, your family will get the sum assured. Example, you've taken a policy of 20 lakh rupees. And every year you're paying premium of 2 lakh rupees. If your family gets the money, on death, it is always and always exempt on humanitarian grounds. If the premiums are all low, what is low premium? Low premium right now is 10% of the sum assured. So 10% is 2 lakh only, you're paying 2 lakh only, the premiums are low. So again, the receipts if you get will be exempt. But guys, if the premiums are high, example, the sum assured is 20 lakh and you're paying more than 10%, example, you're paying 3 lakh rupees premium, then whenever you get the money back, so how will I get the money back in life insurance? Some life insurance companies policies are money back policies. In this case, it will be taxable under IFOS. This used to be the case. This still is the case, but now a small change they've brought in for life insurance policies issued on or after 1st April 2023. So in the exam, if there is any policy before 2023, don't even think about what I'm going to teach you. But any policy on or after 1st April 2023, the government has put one more condition. They have said that in this case policy, same numbers will take 20 lakh and 2 lakh. But now the policy has been purchased on or after 2023. They said that if this policy amount you received in terms of death, no change, it will still be exempt. Next, if all the premiums are low, what premiums low means 10% again, yes, it will be exempt. But there's another condition here. Is up to 5 lakh the premium should be. That means your premium amount should not be more than 5 lakh. I'll tell you the reason why. Lot of rich people used to buy policies. Example, a rich person bought a policy of 5 crore rupees. On 5 crore, 10% is 50 lakh. Every year he's paying premium of 50 lakh. And then when he gets the money, it is fully exempt because it is low. The government says, no, this will not work. Only the premiums up to 5 lakh and low premium. So both you have to see. So now in this case, is it low premium up to 10%? Yes. But is it more than 5 lakh? Yes. So when you get this amount, this will be taxable. On the other hand, policy of 20 lakh where you pay 2 lakh premium. Is it 10%? Is it within 10%? Yes. And is it up to 5 lakh? Only then this amount will be exempt. So now there are two conditions, earlier one condition. And anything that is high premium or more than 5 lakh will now be taxable. So this is the case. Let's see some live examples. Remember, this is only for those life insurance policies issued on and after 1st April 2023. So low premium you also have to check, and 5 lakhs per annum. Not if you've taken multiple policies, again, aggregate should not be more than 5 lakhs. Let's take an example. In 2013, innocently, you've taken a policy of 60 lakh rupees, sum assured is 6 lakh. Is it within 10%? Yes. So the amount will definitely be exempt. Whatever you get will be exempt. But now the policy same is on 2023. The sum assured is 60 lakh, premium is 10%, yes. But because it is more than 5 lakh, this one will not be subject to exemption. And whenever you get this 70 lakh rupees, this will be taxable. It will not be exempt under section 1010D. This was the exemption section. Let's talk about four policies now. 2022, this is before 2023, so only one condition applies. The sum assured is 55 lakh, you're paying 5 lakh 50. Is it low premium? Yes, this amount will definitely be exempt, no questions asked. So this one is exempt. A, B, and C are all on or after 2023. Now in this case, 10 lakh, is it within 10%? Yes. Is this also within 10%? Is this also within 10%? Yes. But now guys, aggregate premium is 1 lakh plus 3.5 lakh, that is 4.5 lakh, and 6 lakh, that is 10 lakh 50,000. The government says, sorry, the aggregate premium should be only up to 5 lakh. But at least I can take for one policy. C policy though will definitely be taxable, guys. There is no idea because it is individually only going more than 5 lakh. But if I combine this and this 3.5 plus 1, 4.5, these two I can still consider the exempt because the policy aggregate value of premium is not more than 5 lakh rupees. So these are the kind of examples you have to see and move ahead. We go to the next chapter, which is called capital gain. This is my favorite because I like investing in the stock market. I buy shares and I sell shares and I pay capital gain tax. Now, there was a very unique section here. I'll talk about two amendments that happened. First, I'll talk about the unique section that is happening. Is if I sell my house property or I sell my land. Example, I have my house, which I sold for, let's say, 1 crore rupees. My cost was 80 lakh rupees. So my long-term capital gain was 20 lakh rupees. Now the government says, listen, if you don't want to pay tax on this 20 lakh rupees, there are two options. You sold a house, so either buy another house. So either buy another house property and take an exemption under section 54. But if I don't want to do that, there's another section where I can buy bonds, if you remember, and there is an exemption under section 54 EC up to 50 lakh rupees a year. There is a small change here. Nothing has changed, guys, very small change. Earlier, the bonds that you could buy were NHAI bonds, National Highway Authority of India, or REC bonds. Now they've given us more options. Options are always good. So they've added some more options. One is Power Finance Corporation. You can invest in PFC bonds. One is Indian Railway Finance Corporation, IRFC. You can invest in those bonds. And one is HUDCO, Housing and Urban Development Corporation Limited, HUDCO bonds. So basically, they've given a whole menu card of 5 items. Those bonds you can purchase, but the same amount is up to 50 lakhs. Perfect. We move ahead. Guys, in capital gain, there is a concept called indexation, but thankfully that indexation concept is now out of the window. They've taken it, made into a ball and thrown it out of the window that we don't want this indexation concept. As a student, it's a great thing that there is no indexation. But only in one case there is indexation. So which is the case that is there indexation? First, you have to be an individual and HUF for this indexation to be applicable. Second, you should be selling any land and building, not gold, not diamond, not shares, only land and building. If this combination is there, then you can look at indexation. So if you're an individual like me and you, and if you're selling a house, land, etc., then there are two options. The first option is calculate the capital gain without indexation and consider it as 12.5%. Or the second option is Hyundai's I-20. What is I-20? I-20 means index the cost and apply 20% rate, whichever is more beneficial. Example, in the first case gives you a tax of 8 lakh rupees and the second case gives you a tax of 7 lakh rupees. Obviously, you will go for the 7 lakh rupees. But in the second case gives you a loss because sometimes index cost may be high. You might get a loss. Let's say loss is 2 lakh rupees. The government says this loss cannot be set off. The loss, if it's there, you can take that option, but it will be considered as zero. So just like Zomato and Swiggy, there are two options now. Only if you're an individual HUF and you're selling land and building, which has been purchased before 23rd July 2024. So two things in capital gains. Let's move ahead in set off and carry forward of losses. As you know, If you make a loss, unfortunately, that loss can be set off against other heads of income. And if you can't, you can carry it forward to the next year. Now, two changes have happened in the default tax regime. Guys, do you remember the section 115 BSC, better available choice? In that case, if you have a loss from house property. So how do you have a loss from house property? Loss from house property can happen because your LOP interest, etc. is very high and there you have a loss. Let's say of 1,80,000. Earlier, this loss could be set off against other heads of income. If you remember my shortcut, this head of income was friendly. That means I could set this of 1,80,000 from salaries, PGBP, capital gain, even IFOS interest, etc. But now this loss cannot be set off against other heads of income. You can set it off only within your same head of income. So if this is a loss and there's another LOP2 which has a profit of let's say 1,90,000, then can I set it off? Yes, that's the first change. Second, if there is a loss, example, this 1,80,000 could not be set off this year. Earlier, I would carry it forward for 8 years, but under the new regime, now also it's there, but under the new regime, sorry, you cannot carry it forward. You have to set it off in this year only. So it's a 1 year game. So these are two changes in set off, but only in the new regime. In the old regime, you can still set off house property loss up to 2 lakh, and you can still carry forward the loss up to 8 years. We go to the next one, which is deduction chapter. In deduction chapter 1, very unique deduction is there. So in deductions, sorry, this one is not from deductions. I'm going to remove it. This entire document in Word format is linked in the same video. So you can just click on that link and access this PDF as well. Also, if you want to revise revision videos, etc., or you have any tax doubts, I'm sending a Telegram link here. You can access the Telegram link, ask me a doubt, either type it or send it through a voice note, and I will reply back and we'll help you understand and solve your doubts. Deductions. Guys, as you know, once you reach GTI, gross total income, the government says, listen, we'd like to give you deductions under chapter 6A. In that, there are different series, 80C, 80D, 80E, etc. There is a small clarification that I want to bring about in the deduction called 80CCD. Now, you and me know in our classes, the shortcut for CCD is National Pension Scheme. National Pension Scheme was created at CCD. That was the shortcut. And guys, now what is National Pension Scheme in a nutshell? National Pension Scheme is a way to save money for your retirement. So you open an account, example, you go to the post office, open a National Pension Scheme, number 123, let's say that's your account number, and you can deposit money which you can use for retirement. Till you deposit money in that account, the government is happy because the government gets to use your money and they give you some deductions. Here are the deductions. The first one. When you self-contribute, you will get a deduction under 80CCD1. That means they will give you a deduction because you contributed to this, but that is only up to a limit of 10% of your salary. Or if you're not salaried employee like me, then 20% of your GTI. Remember, this also, there's a limit of 1,50,000 also, which applies overall. So it should be within 1,50,000 also and 10% of salary also. Let's take an example. Let's say you've contributed 2,20,000. Now, first of all, 2,20,000 will not be allowed because only 1,50,000 will be allowed. So, okay, 1,50,000, can I take a deduction? Now, there's another limit of 10% of salary. Let's say your salary is 9 lakh. 10% of 9 lakh is only 90,000. So, you can only deduct 90,000. So, there are two limits now. You have to be basically within both the limits. That is 80CCD1, that is self-contribution. But what if I want to contribute a little more? Example, 2,20,000. You were allowed 1,50,000. From that also, you were allowed only 90,000. So only 90,000 you got a deduction, but you contributed 2,20,000. So the government, to incentivize you or to push you to contribute, they said this 90,000, so definitely I'll give you deduction. Plus I'll give you 50,000 rupees more deduction under 80CCD 1B. It's a one extra benefit. That's how this is, both are self-contribution. Now, let's say your master also says, I will contribute to NPS. So this is the same NPS account, number 123. But this time you're not putting in money, your employer is putting in money. Example, he's putting in 2,05,000. Now, because he's putting in money, this amount will first be taxed under salary. But because it is an NPS, you get a deduction under 80CCD2. The second one is when the employer is contributing. Here also it is up to 10% of salary. But if you're in the new scheme, then you'll get up to 14% of salary, which is a deduction. So 10% of 9 lakh is 90,000. But if you want a higher deduction, then you go into the new scheme. In the new scheme, but you will not get 80CCD 1 and 1B, by the way. You will only get this one. In that, 14%. So if your salary is 9 lakh, 9 lakh into 14%. So you will not get 90,000, you get 1,26,000. So the choice is yours. If you want to follow the new scheme, this 14% deduction you can take under 80CCD2. Revise it. It's a little complicated for most people, but if you take it individually, separately, if you understand, it should be good. We go to the next chapter, which is called TDS, TCS, and Advanced Tax. A new section has been introduced, section 194T. Let's talk about 194T. As you know, there are some partnership firms and there are partners A, B, and C. If you remember, partner C always dies, but we're not making them die right now. The partnership firm can pay them salary and interest. This salary, as you know, is taxable under PGBP, and this interest is also taxable under PGBP. Share of profit, by the way, is exempt. We're talking about this salary and this interest. Now, when A gets this money, he will be taxed on it under PGBP. So the government says that if this amount received by a partner is more than 20,000 per annum, then the partnership firm will have to deduct TDS under section 194 T for trust, because partnership firm is obviously based on trust. Next, there's a section called 194A. Example 194A, A for Axis Bank. I put money in my Axis Bank account, and when I get interest more than 40,000, senior citizens more than 50,000, then there is TDS at the rate of 10%. Now, somewhere there is a small change. Not a big change, actually, very small. Uh, there is a Mahila Samman Savings Certificate scheme introduced by the central government, whereby you go to the same bank, but you open a Mahila Samman Savings Certificate, MSSC. Now, when you open this MSSC deposit, what is this deposit? You can maximum deposit up to 2 lakh rupees and earn interest of 7.5% for 2 years. So, limited scheme, limited amount, but good interest rate. Now, in this scheme, whatever interest you earn, there will be no TDS. It will be taxed, but there will be no TDS. Next, very, very important, 206C1G, we are coming to TCS. Guys, as you know, TCS applies on some goods like cars, more than 10 lakh rupees, like tendu, leaves, like timber, so alcohol. So on some goods, there was TCS. Now TCS is also there on foreign remittances. Let's recap. So there is a person called A who's selling some foreign remittances or sending money abroad through a scheme called LRS, Liberalized Remittance Scheme, or he's sending money for medical purposes or education purposes or tour and transfer. I made a shortcut called MELT, MELT, Medical Education LRS and Tour and Transfer. Then the government says, listen, collect something extra from your customer and pay to the government, that is TCS under section 206C 1G, 1G for global. Now here is the deal. The rates are like this. If you're sending it for general purposes, and general I mean medical also is included, for general purpose if you're sending, then up to 7 lakh rupees, I'm making a threshold like this, up to 7 lakh rupees there is no TCS, but if it goes more than 7 lakh rupees, then there is TCS at the rate of 5%. This is in general cases. If you're going for education purposes, taking a loan, not any others, only loan, then in that case up to 7 lakh rupees, again zero. And after that, the ideally on education on loan, poor guy is taking a loan, but still the government is above 7 lakh rupees. There is 0.5% TCS. Keep in mind. And last is tour and transfer. The government says India is so good. You want to see high buildings, you go to Gurgaon, Mumbai, and Bangalore. Don't go to Habibi, Dubai. If you do that, the government gets a little upset. So on overseas tour is not booking your flight tickets. The overseas tour is actually taking a tour programs from KC Travel, etc. Then up to 7 lakh rupees, there is TCS at 5%. And above 7 lakh rupees, there is TCS at the rate of 20%. Keep this in mind for sure. This is tour and transfers. Sorry, this is overseas tours. Now, if I use my credit card abroad, is it there is TCS? No. If I only book my flight tickets or hotel stay on some website, is there TCS? No. Next, guys, the thresholds are different. For LRS, the threshold will be considered together. Example, if I spend first 7 lakh rupees on some LRS buying shares abroad, and then I send 10 lakh rupees on for medical purposes, so 10 plus 7, 17 lakh will be considered and you will apply the threshold. It's not separate. But this is different from overseas. Overseas and LRS will be different. Example, let's take an example. You have sent 10 lakh rupees for LRS. Let's take an example. Yes. You have spent 10 lakh rupees and sending money through LRS, and you have sent 9 lakh rupees for foreign overseas tour. Now, will this both be combined? No, they'll be separate. In this case of LRS, up to 7 lakh rupees, there will be nothing. And above 7 lakh, that is on the 3 lakh into 5%. So 3 lakh into 5%, there will be TCS of 15,000 on this transaction. First one. And the second transaction, up to 7 lakh at 5%, that is 35,000. And on the excess 2 lakh, there will be 20%. That is 2 lakh into 20% is 40,000. So 75,000 will be applicable. This is the case. These are the amendments. This is something new. Last one is return of income. As you know, guys, every time the year gets over, you need to file a return of income. Right now, we are in the month of September. The period between July and September, October, November, we have a shortcut called John as well, is the period when people file the return of income. Now, let's assume, guys, you filed your return of income. Let's assume this is your previous year, 24-25. For that, you have to file your return and assessment year 25-26. Let's give you perspective. The year ends on 31st March. On that time, you know what is your profit, what is your loss, how much is your income. And by July or October or November, you will file your return. The government allows you to file even till December. So by 31st December also, you can file a belated return, but not after that. Now, let's say life has moved ahead and you're in the next year, assessment year 26-27, and suddenly you remembered that you forgot to show some interest income to the government. You earn interest from some friend and you forgot to show it to the government. Now what? So if you go, the government does not allow you earlier to file your return now, but now the government has kept a separate window. And that window you can knock and they will open the window and take your updated return. Yes, that word is called updated return. And that updated return they will take only up to 24 months. That is after the assessment year ends for 1 year, assessment year 26-27 and assessment year 27-28. Up to 24 months, that is 2 years, they will take updated return. You can file it here also or you can file it here also. But there's a catch. This window will open up only when it's for the benefit of the government. Example, you cannot file updated return if you're going to reduce your income, if you're going to reduce the tax that you pay, if you're going to increase the losses, if you're going to reduce or increase the refund. So anything that is in the benefit of yourself, you will not be able to file updated return. Then why will people file updated return? So that they come out clean and the government does not catch them. And lastly, if for 1 year you already filed the updated return, then you cannot again file an updated return. Also, if for a particular year you have already been assessed by the assessing officer, then you cannot file updated return. So some cases you cannot file updated return. Now, when you file an updated return, they will calculate the tax. Example, your tax is 100 rupees plus your interest is 20. So 120. On that 120, you'll have to pay 25% extra. That is 30%. That is called additional tax you'll have to pay. So 25% you have to pay extra in the first 12 months. And the same amount, 100 tax plus 20 interest, you'll have to pay 50% extra. That means, let's say rupees 60, you'll have to pay extra. So remember, 25% and 50% extra in the next 12 months. This is the additional tax you have to pay because you did not come out clean when you were supposed to come out clean. This is called return of income, updated return. Section is 139(8)(a), important section, keep it in mind. And the last, guys, you have a PAN number, but that is not enough. Now you also need to update your Aadhaar number on the income tax portal. And if you don't do that, your PAN will become inoperative. So, sir, what? I have a PAN number. How can they make it inoperative? Yes, they can make it inoperative. And there are 4 consequences of PAN becoming inoperative. First, if you're expecting any income tax refund, you will not get that in that period. Next, if you're supposed to earn interest on refund for that period, the interest will be stopped. Next, TDS will be applicable at a higher rate. Remember the 20% rate, etc. And TCS will also be applicable at a higher rate. So these are 4 consequences. If your PAN becomes inoperative, very dangerous situation. So how do you make it operative? You pay a fee of 1,000 rupees under section 234H. H for home, as Aadhaar is a proof of home. That's how you remember. Then guys, you'll give 30 days, the PAN becomes operative. After that, only the PAN will become operative. So this is the case of PAN becoming inoperative. This section does not apply, inoperative does not apply if you're staying in the states of Jammu and Kashmir, Assam and Manipur. If you're staying there. If you're not an Indian citizen, then this does not apply to you. If you're a non-resident, then this does not apply to you. And if you're someone who's over 80 years of age, then this section does not apply to you. So these are 4 cases where this PAN in operation will not apply to you. Guys, these are the amendments. Watch it. I know when you study tax, there's a constant fear that am I studying the right thing? So study what is there in your books, complete it, watch this amendment video. Also, I'll be sharing links of revision videos, etc. But I share all those links in one particular Telegram channel only. So I'll join it. If you have any doubts, also you can ask it so that we can address everything at one place. I have made that. I will also give the GST amendments after this. So watch this as DT amendments. Study well, study, revise more. In the last one, don't study anything new. And remember, DT and GST is a combination. You will get your 50, 60, 70 marks. All the best and see you very, very soon. Signing off.